Today we have come up with some different format from our normal video recordings. Today we are going to do a podcast. So you must be thinking, why this podcast? Many of my subscribers, my well-wishers, friends has been always telling that whatever I am putting in the channel has been a one-sided communication. But then this idea of podcast is to understand what the normal investor thinks about the channel and what they want from the channel, and try to understand their thinking and try to modulate the content of this channel as per that. And also probably from this day onwards in the weekends we'll come up with such podcasts wherein we'll discuss, debate on various topics and try to understand further on the subject. So here today we have Mr. Sangram, my friend, and he lives in the same society of mine, and he is also into this field. We will have some debate on the favorite topic, value investing. So the topic today is the value investing still valid in Indian stock market? And we will explore and debate whether this value investing can be applied in the stock selection in Indian market, and what are the nuances in the sector, what are the evolutions from the typical Graham model or Warren Buffett model of value investing, and we will further explore on those topics. So welcome to the show.
Well, thanks Vijay for inviting me here. So myself Sangram Chavan, I am a senior manager, works with Vodafone, and I have been studying right now the executive MBA from IIT Bombay, Washington University, and there are quite a frequent occasions I come across the economy, finances and investment obviously, and when it came to my mind, I naturally went through the channel that Vijay runs from last 4 years, and his philosophy is simple, that an ordinary investor can make extraordinary decisions if he understands the business value, if he cuts off himself from the market noise and practice some patience.
Absolutely.
So that's why I am attracted to Vijay channel. But at the same time, I also feel that needs, if you follow his channel and his videos, that needs some prerequisites about investment and finances. And I think that needs some intellectual, or not intellectual, but some intuition to understand that. So before we jump into the topic, I'm asking Vijay that is there any way to maybe pre-prepare or get ready to dive deep into your investment suggestions?
Right.
Maybe is there any playlist or anything that covers the basics?
So I get this question frequently from the subscribers. So as you represent a normal investor here, and that's the theme of the podcast today. So I would like to explain a good question. So there is a lot of playlists been made in the channel. So if you see what is value investing, what is the basics of value investing, what are return ratios, what are financial analysis ratios, then what are how to read a annual report, a balance sheet, a P&L statement, a cash flow statement. So all these things are organized under various playlists in the group. So whoever is subscribed in the group, he can go to the playlist and see the basics, or from where we started. Like 4 years back, it was just like it was started from scratch, as if the person who is listening doesn't know anything about investing, or well, in that case, value investing also. So what is value investing? What are the basic principles of value investing? How is it to be applied in the market, whether it is Indian or foreign markets, to choose value stocks? So this all are covered in the playlist.
Okay.
So
good enough. I think I encourage people to go and maybe go through these playlists so that you can understand the basics. And coming to the topic today, because it has been a new format. So today's topic is the value investing dead in Indian stock market. And to touch upon, I think Vijay can start with the basic definition, because sometimes we just or myself being a ordinary investor, I confuse with price and value, and I am sure that most of you would be confused about these two, and then if you may maybe misinterpret, and then you tend to make the wrong decisions. So we can hear from expert. So Bijoy, what is actually the definition which can be understood by the ordinary investor? What is the definition of the value investment?
So before that, I will just borrow a quote by Warren Buffett that price is what you pay and value is what you get.
Yeah.
So anything can be bought at any price, but what price you buy that stock, or well, in that case, anything. The value investing is not just applicable for stocks. It can be applicable for a flat, a land. So you have to find the actual net worth or the value of that particular thing. So in this case, let me borrow Indigo, Interglobe Aviation, a stock. So we know, we found out a value, original value of that stock. So what is the original value of the stock? It is the actual net worth. Like if it is liquidated today, what you get in your hand is what is value.
Right.
And there is a lot of froth in the market. Means some people anticipate that going forward in next 15 years, Indigo is going to be an international carrier, and there is a lot of revenue generation. So the net worth of the company will go so exponentially high. So they are pricing that in the current date and paying, say, so a PE ratio of 30 means he is paying 30 rupees to get 1 rupee profit.
Okay.
A PE ratio of 100, say stocks like DMart. So 100 means he is paying 100 rupees just to get 1 rupee.
1 rupee.
So as a value investor, a 100 PE is like suicide. So we believe that the value has to be found out, the net worth. We call it as intrinsic value.
Yeah.
So there are various models like discounted cash flow model. So in Warren Buffett terms, we are getting cash from that investment, right? So end of the day, cash matters. So whatever cash flow the company is giving for the next, say, 30 years of your investment, that cash flow is discounted to present value, and we will find the intrinsic value of that stock.
Right.
That is the stock price.
Okay.
So intrinsic value of a stock price and the actual stock price. So if you have at least 30% discount of the stock price which
To
is
the actual
which is in
price.
the market,
Yes.
and to what we have calculated, which is the actual worth of the company. So if you have a 30% discount, you are having a discounted price of the actual company, and that is called the margin of safety.
Okay.
What they call is the margin of safety.
Right.
So the margin of safety is required so that even if you have a market crash, a company having some revenue issues or profitability issues for say 1-2 years, this margin of safety will help you and it will protect your capital.
Right.
So Warren Buffett used to say that you should never lose your money.
Right.
And the second rule is that ensure first rule.
Yes.
So value or money should never be lost in the market. For that, there are some basic principles for value investing. So value investing, to conclude, is investing in the stock at the correct price and stay long. Staying long is very important. So if you invest in that stock, so Indigo I have bought in 2016 and still I am holding. I had bought at 800 and now it is at 4,500. It has gone up to 6,000 also. So somebody asks me when you will sell it. So I will tell that it is, the holding period is forever, and maybe at 20,000 levels I may think of selling it. So that's about the value buy and sitting, allowing the company to generate profit. So stocks are pieces of businesses. You buy the business, allow the business to expand, and you enjoy the profit. And so-called PE also expands. So that is called PE expansion.
Yeah.
Yeah.
I think that is fair enough. The definition was very detailed definition, and it also covered the margin of safety.
Correct.
And to put it in the layman's language, okay, it is something like if you're buying something, okay, right, it's about stock especially, if you're buying, but it has the ability to reach something that is its intrinsic value. Means if you're buying a stock at 50 rupees and it has the ability or capability to grow until 150, and that is based on many external internal factors, the company's growth and all that, balance sheets and all. But to make it a conclusive statement is that value investment is something that you have the perceived value of some stock and you are spending right now calculating that perceived value, and there is some maybe margin of safety that guardrail you in case of my market shocks or anything like collapses in market and all that. So it was fair enough. But I want to put it like this. It will be kind of a provoking question that it's right that you put the value investment giving all the returns, it has the margin of safety and all. But in the growth stocks as well, okay, we are getting the high margin, okay, and we are even calculating the PE and all these things, okay, in a similar fashion. But it gives me more returns, and comparatively the value stocks are not performing that way. So what's the reason then?
First, I'll slightly correct you that momentum stocks, that's called momentum stocks. Growth stocks or momentum stocks, wherein they keep on increasing and they are traded at a very high valuation. Whether it is price to book, price to earnings, everything will be at a higher valuation compared to my value stocks.
Right.
Value stocks, earlier the Benjamin Graham used to tell that these are like cigar butts. So there is one last, somebody has puffed it, they had thrown it away, and there is one last puff available in that. That's a value investor goes and puffs it. Even though it is dirty, we try to puff it and get the last thing, puff out of that. But you should understand that it's a free puff. I have not bought that cigarette. It is free for me, but still I get that puff.
Right.
Similarly, in a value stock, if the company is good, so there is a clear definition between a value trap and a value stock. So value trap is that the PE is so low, so maybe below 5 also, or maybe below 2 also, and the price to book is like below 1, means it is trading below the net worth of the company.
Right.
So there you should first understand why that has happened into that stock. Maybe the company is so poor, it is going forward, it is going to be bankrupt. That is why people have not valued that, and the stock has been trading at that valuation. So it's a value trap. But then value investing is that it's a very strong moat. So moat is like it's a castle with strong business shield or fence around it. So nobody can, the new entrant cannot enter that business. So the business should have a strong moat, an economic advantage, and it should be a trusted business, a trusted management, a good business model. And you should, as I told, you should be able to trust the management and the company and project that. So I am telling that next 30 years I am projecting the cash flows which is going to give me, the free cash flows it is going to give me, and I am discounting that to the current date and understanding and finding out that value of the stock. So if I have to understand the cash flow, I am assuming that in say next 10 years it is going to give me say 15 to 20% cash flow every year.
Right.
So if I am unable to predict that 20%, then there is no point of me projecting that 20%. So the business should be understandable and it should have a strong economic moat, and the price of that stock has gone down not because of that particular company's issue. Maybe there is a Russia-Ukraine war, there is a US-Iran war which is going on, external factors, and maybe it is say indigo, it is related to crude oil. So crude oil prices shot up because of the war. So the stock has beaten down, say from 6,000 levels, it has gone back to 3,900 levels, and now it is climbing up. So because of that external factors, the price of the stock is available at a lower valuation.
Right.
So this is one example I am telling. There will be different number of examples wherein because of some external factor or an internal factor which can be later mitigated or resolved. So we will get a chance in that stock, and then we have to find value in that and invest. I am not telling you to invest in a kachara stock wherein it is not going to get out of that forever and he will keep on trading at that PE valuations over the full lifetime. So that is not what I am talking about. And coming about your question of momentum stocks. So momentum stocks only will perform when the market is at an uptrend. And as you know, the market is always in an uptrend in a longer duration, but it always has a fluctuation.
Right.
It's a sinusoidal wave.
Yes.
So every time it goes down, the momentum stock also loses its momentum as the name suggests, and it will go down. Right. So you cannot time the market. But then in a value investing, you are not timing the market,
right,
but you are understanding the actual value of the business, buying it at a lower valuation and waiting for a very long time. So that whatever momentum stocks you are telling, the growth stocks you are telling, whatever returns they are telling, It is proven that over a period, the value stocks has always crossed the returns of that. But then in 6 months, like the new people are thinking that if I buy the stock now and in 2 months, it will explode. It never happens in value stock because it is undervalued for some reason. And that undervaluation has to be mitigated and it has to explode its profitability. So it will take time.
Okay.
So it is a patient game with people who are having resilience, long-term view. They only will make money in value investing.
Okay. Well, I think it was a good definition of what value investment is and what growth stocks are between these value stocks and growth stocks. But still, the same question that why growth stocks are getting profits in a short period of time, and what's your take on the momentum stocks, like because there is short difference maybe or a thin line between these two.
Yeah.
So I think I would like to learn more about it from you.
If you see, there is a big difference between a momentum stock and a value stock.
Okay.
So momentum is especially for short-term duration trades, like people call it swing trade. So maybe an intraday, a monthly, or a 3 months view or a 6 months view, not beyond that, or maybe 1 year view to the maximum. So if you see the momentum stocks means it is participating in the momentum of that. So they do technical analysis, all those things, not a fundamental analysis, wherein they, if a fair amount of fundamental is also done, but not that deep as compared to value investing, and they participate in that short stories like 360 rupees to 400 rupees. So 40 rupees gain they will tell. Then after that they will book the profit, pay that capital gain tax, then move on to other one. So you have to keep on researching and spend a lot of time and efforts, and also pay a lot of tax as well if you are a genuine taxpayer. So this is all about momentum. So momentum is for short term trades, and the profit margin which you will get and the efforts you will have to put, and the success rates are also very less compared to the value investing, wherein in value investing, as I told, you are investing in a business which is undervalued, and in momentum you don't look at the business as such, but only the momentum or the current trend of that stock is seen, and it is going up and it is giving some 40 rupees returns. So you participate in that and book. So you are not concerned that they are setting up a semiconductor factory in Gujarat, or they are setting up a manufacturing firm in West Bengal or something. So you don't analyze that.
Especially what you mean to say is that it is based on the period of investing, and it's kind of joining the momentum.
Yes.
For instance, if let's say there is something happened in a bank.
Yeah.
Okay, maybe the management failure, anything, or change of management or something like that. So that you know that this is happening.
Yeah.
And you also know that this is not the face of that bank or something, because it is something that it will come for a short period of time. So you just have to gain the profit out of that situation. That is as like it. But you are not sure that if you try to invest more and get the more profit, because that is circumstantial.
Correct.
So you put it in a correct way is that if you are looking into value investment, you care about how that business has been founded.
Correct.
What's the philosophy? What's the product and portfolio?
Correct.
What's the service they are offering?
Correct.
And long term,
what is the free cash flow they are going to generate over the period of?
So basically you follow the techniques, okay, the tactics, or maybe the calculations over the emotions. Right now I know that this bank has changed the MD or CEO or CTO or somebody else. So you know that will impact on market shortly, and I have to just book the
in a short duration. So maybe they short so it's not on positive side. They short the stock also, so it falls from 50 rupees to 10 rupees.
So it's as good as gambling.
It's pure gambling.
And even if you look at the intraday market, right? So we know that it is gonna end today. I have to get maximum.
You have to wind up the position on the same day.
So if I'm at 400 and it's giving 420, I just don't look at the company's P&L balance sheet and all
nothing,
that. So I just book the profit and exit.
Yes,
but that is riskier that you say.
That is riskier.
Okay, so I think it is a good perspective that Bijoy is trying to.
So
put us.
one additional point is that investments, like again Warren Buffett told that investments should be something which allow you to sleep peacefully.
Right.
So again, options these days it is getting momentum. So they don't have peace of mind. They don't sleep properly because tomorrow some war is going to happen. Their position is screwed up,
Right.
and the complete profit is gone. So we don't gamble in value investing. It's very safe. So there is no risk. So risk is something if you don't know about it. So if you know in and out about it, it is never a gamble. Often it is told that stock market is a gamble. Yes, it is a gamble if it is a momentum trading or in fact a trading, short-term trade. But in value investing, there is no risk, I would say. It is all about knowing what you are doing.
Right. So I think this is what we should know as an ordinary investor, that our objective is to be the sustainable in the stock market, that we will not lose much. Okay. But in value stocks, I think there is guarantee that if you follow the patience, if you be persistent, then I
And
think
do your right analysis.
then we can get as much as benefit from the value stock. So I think Bijoy, that again open up the topic to maybe topic for the discussion is that means how much time, okay, we should. I know your answer is like it should be infinite time, but still, if there is a new investor, okay, the
Entering
retail
the
investor
market,
enters the market.
Yeah.
So he has no information. So he moreover goes towards the rumors, okay, goes over the social media and all that. So what is the ideal time you think that the retail investor should maybe invest for so that he can get the maximum profit out of it?
First of all, in investing, there is a basic principle that the investing should be done in such a way that that money is not immediately needed for him for next say 2-3 years. It should not be an emergency fund which he's been investing in that stock and घर का लोन का EMI पे करना है तो वो इसमें से निकाल के पे करता है, something like that. So that should not happen. It should be the money which you are parking here should be a money which you should give time and enough time, in fact, to grow. But now the right question is here is that people want overnight returns.
Right.
Like in 6 months they want the return. And if the because we cannot time the market. A war can happen. Russia can go and attack Ukraine. We cannot tell Putin that please don't do that. My portfolio will go down.
Right.
So that you cannot predict. But then if there is, and the market is bound to be volatile these days. The old times are gone wherein it is stable. Now the VIX keeps punching up and down. So there is lot of volatility. But then the holding period, if you are, for an example, there is investor me and investor you. I am investing for 1 year and you are investing for say 5 years. So the lot of volatility which I am having is completely mitigated in your 5-year case. Because a war won't end for 5 years. A war may end for 2 years. Not beyond 3 years.
Right.
Or 4 years or 5 years. So your returns, you are bound to have a return if you are having a longer period of holding.
Yes, yes.
So that is why I am telling that we should have a longer period of holding.
So I think the discussion is becoming interesting because you are opening up with some new knowledge, you are giving new perspectives. So I am feeling moreover I am getting the new it is correcting my concepts about finances on investment. Yeah, we talked about the value investing. We talked about the momentum and growth stocks, okay, what it is in a financial or investment point of view. But coming to Indian stock market, so it is interesting to see that from maybe I think after the COVID or maybe post-COVID era, it has been observed that people are putting more money into these momentum stocks and they are earning well as well in a short period of time. So there is a belief that people are now switching to, or maybe they are believing that the value investing stocks are dead. They are no more exist. So what do you think? Because see, I am talking with my experience that people are investing, my friends, and sometimes I also invested and earned a good return.
Yeah.
But does it mean that the value investing dead? What's your point of view, or how would you like to elaborate if that still exists?
So nice question. So if you see, I will just refrain our discussion in Indian market. So if you see a typical case of COVID, so in 2019 we had a COVID impact and the market was having the quick recession at that time. It was the short period recession in the whole financial history. It was the shortest recession. So it was a buying opportunity. So it is something external. The companies have not done any crime, but then because of this external factor, all the stocks almost took a nosedive. So I could see many of my friends and subscribers were actually selling that stocks, and they were allowing the or giving a lower price for actual value investors to invest. So if you see, you should be fearful when market is greedy, and greedy when market is fearful. So if you see a contra view, you can say. So what happens in that case is that in case of COVID, like healthcare stocks and also pharma stocks, so they were going so down, and we have been in our channel also we have been telling this. So if somebody has invested at that time and followed our channel and all those things, so they would have made multi-bagger returns in those stocks.
Right.
What happens? So the stock has fallen to very close to their intrinsic value, or maybe below that also. So a typical value investing principle wherein
I would like to correct, because you only told me this.
Yeah.
Value was itself, right? Value was at that point only. The price may have fallen down
to that actual value of that
below
stock.
the actual value.
Yes.
Now
So that's a typical case wherein you are getting a value stock.
See, I learned from you.
Yeah. so if you see in that the value is understood, and then at that time if you invest, so somebody would be thinking that I am talking about COVID times. So the past is past. Why should we talk about the past?
Right.
But then if you see my recent posts as well in our channel, like I have been talking about the US probable recession or the US economic crisis, similar to what we have seen in 2008 financial crisis.
Right.
So that is probably expected, because a country with a $40 trillion who is spending more than $1 trillion more than his military spending for the EMI interest payment, is bound to melt down, and he is trying to do some war and bring the crude oil price under his control, and trying to arrest the higher interest rate and bring down the debt burden, which unfortunately is not happening. And if US sneezes, the whole world gets cold. So we also will take the hit, and probably there is opportunities with you wherein you will possibly get a crash, and you can always invest wherein the price of the stock falls so low below its intrinsic value, and then you can find value in that, and you get a lot of margin of safety and make a multi-bagger return going forward. Yes, this recession, if it hits, it is not going to recover in 1-2 years. So again, the long-term perspective which we talked about. It's not momentum investing, it's value investing, wherein you need to give a lot of time for the stock to come back over its intrinsic value and give a multi-bagger return. So opportunities keeps coming, crashes happens in the market. To answer your question, value investing is very well there. It will never be dead. Maybe Warren Buffett's era goes away. Maybe Greg Abel, the new CEO of Berkshire Hathaway, comes in. He is investing in IT stocks, including Apple and Microsoft and all. But then the stock themes may change, but the principle of value investing remains. The value going below its intrinsic value, investing in them, stay long, be patient, be resilient, give time. The multi-bagger return happens to you, and then you can sell. So momentum, I am very strongly still against momentum investing. Value investing really exists in the Indian market, well in that case in the foreign or international market as well, and you can apply those principles and still make a lot of money.
Okay, so people who are watching which are similar to what I am, like an ordinary investor. So sometimes, I would say the momentum investing or momentum stocks are euphoric, right? For a reason, because they gives you the, I would say, imaginary profits. Not imaginary, but actually the calculations and the themes are imaginary. And value investment, whereas gives you a strong foundation, and it will be there, as he rightly said, that though theoretical it may look, but it will be there. It will make us profitable. It will survive like anything. And I'm somehow now agreeing to you that I was maybe later the day we talked, and yesterday we talked about, and we debated already yesterday only, that hey Bijoy, why are you telling about these stocks, right? The value investing stocks, whereas all our other friends were making money out of momentum stocks. But now it's clearer. But again, a practical question, okay, is that because sometimes people may put a long hours or long day in maybe calculating the company's profile, the balance sheet, and all that. So the quickly, okay, means how do we think that a particular stock is undervalued or overvalued? For instance, we may not be able to, being an ordinary investor, I may not be able to understand that intrinsic value of that particular company. If let's say that is 100, it will make, or maybe right now it is 20. So how do I know that after a certain period of time it will hit that intrinsic value and I will get the profit? So what's that golden rule or something? It may not be that simple, but how would you maybe let people know that that has undervalued and you should hold until it reaches its intrinsic value?
Okay. So it's a nice question. So how to understand that a stock is a value peak or it's undervalued? Though it's a very large topic to discuss as such, but some simple techniques I'll tell you so that you can understand whether this is undervalued or not. Prima facie, what we look at is some few ratios. So you look at price to earnings, but the earnings can be manipulated.
Right.
But then you can look at price to book. So the price of the stock to the book value of the stock. So if it is below 2 or 1 and price to earnings is below 15 to 20. So these are prima facie screens for understanding the stock is undervalued. Then you go a step ahead and you see the return ratios, ROE, ROC, then the free cash flow,
Okay.
FCF, means the operating cash flow minus the capital expenditure of the stock. So there you will get the free cash flow. So is the free cash flow consistently there? Positively for last 5 years or something. Because undervaluation is one thing, and if the business is not performing, so that also you should understand.
Right.
So first undervaluation you check, then second, if the business is performing. So business is performing and stock is undervalued is one initial screen for understanding and getting into the valuation of that stock. And then a quick one is that normally we used to do discounted cash flow model in an Excel, wherein you have a lot of assumption and calculation in that. I have explained that in one of my video. I'll leave the link. But then the quickest way of doing it right now is that you can go to ChatGPT, put the stock name and tell that run the DCF calculation for the next 10 years and find out the intrinsic value. So for an example, there is Elementary, a stock,
Right.
and its stock is currently trading at some 110 rupees or something.
Right.
And understand that what is the intrinsic value. So go to ChatGPT and put what is the intrinsic value of that stock. So it will give some value, a base case, a moderate case, and a bull run case.
Right.
So you can compare that value with that particular stock value and understand if there is a margin of safety. Means if it is 30% lesser to the traded value, you are having a 30% margin. And if it is still trading at the fair value and the intrinsic value is similar to that fair value, you should wait if you are going with the value investing.
Okay.
And many times in intrinsic value calculation, there are a lot of combinations. Like if you are assuming a growth, a standard growth, if you understand, then it may be, the intrinsic value may be lesser.
Okay, I think I understood the importance of calculating these ratios so that we can term any company that it is undervalued or overvalued. There is also a catch that I heard from you is that it should be with some performance, like it has not reached that intrinsic value and it has the potential. And it is because of the nature of the business, but it should not be because of the business's management is not able to make that. And in that case, they will never be able to make that. So that's the fall. But I think if that has potential, it is running very well, it has good balance sheet, and all of the ratios that
Because
you
it's a combination of ratio analysis, valuation analysis, fundamental analysis, business analysis, management analysis. So this all these things, and reading all the balance sheet for last 10 years, which you can use ChatGPT and Anthropic, which I have mentioned how to use that as well. So that elaborate usage is also shortened now because of the
Right.
AI pitching in. But then these things, though we have told this in 5 minutes in this podcast, these things are elaborated in the so-called playlist which I am talking. So wherein you can understand what is the ratio analysis, what is the intrinsic value calculation, then all those analysis is listed in the playlist. So each of them you can go through, because once you go through, then you will collate all these things and use that in your analysis. You may find this elaborate, but it is not elaborate. Once you do that, then it's part and parcel of your analysis.
Right. So I think, see, as he spoke, okay, I understand that he has already given some videos or kind of a playlist for understanding the
Yes.
prerequisites when we spoke about the investment. He has already recorded those. When we spoke about the ratio analysis and
Right.
intrinsic value calculation, he has already the playlist on it. So it is just us to go through all the playlists and the material that he has posted on channel. And I personally attest that the importance of these intrinsic value analysis, the importance of these ratio calculations, because I personally underwent almost 35 to 40 companies detail analysis as a part of my executive MBA in IIT Bombay.
Okay.
So our professor in IIT Bombay, he has pushed us and we did it manually as and you don't have to do this because that was part of our curriculum.
Absolutely.
But ChatGPT, as he correctly mentioned, that it has all that you need, just is to give the name of the organization.
We should use AI to our good
Right,
use.
because
Yeah,
that
yeah,
is
yeah.
how the intent is.
Right.
So I think because he has been putting more efforts, and he had actually opened up the channel 4 or 5 years back, and he is putting so much efforts to get us the free material so that we think of the investment as a priority of our life. And as you figured out, the basic fundamental thing is that value investing is. So as we started with the thought or with the debate, that is the value investing dead or it still exists. So from the Indian retail investment point of view, it is still exists and it will be there. It is just kind of some calculation you have to follow. It just you have to refrain yourself from the emotional things. Before concluding, so it is with the interest of time, for the betterment of the new entrants in the investment. So what one advice would you like to give them so that they never fall in the loop of these traps and they will make profit out of it? What's that one advice?
Again, I'll borrow the wordings of Mr. Warren, that integrity and resilience is one important thing. So don't get swayed away by the so-called YouTubers or the market hype or the market noise or the tips which you get in your SMS or Telegram, or even the news channels which actually frame you retail investors to invest wrongly and make money for large institutions. So the system is designed for large institutions to make money with the money of retail investors.
Right.
So you should first understand and think like a institution, which I always tell in my YouTube videos, that you should think as an institution and never get in their trap and invest like them. And discipline is one thing which you should always follow. So if you have a disciplined, a standard process of investing, a set of instructions or set of calculations or tools which is in place, and if Sangram comes and tells me that today ye stock le lo, so you just buy it, it's not the way.
Right.
You should, if you are putting your hard earned money, especially newcomers, they have got a very less salary currently as we speak, and the salary only grows as it grows. But then even with a small salary, it is very important to know that you can make large capital, because you have 50-60 years ahead in front of you to participate in that compounding journey. Compounding is the one of the wonders, like Einstein used to tell. So this will help you compound your wealth. Don't get swayed away by the market noise. Have your own due diligence. If you are putting your hard-earned money, you should know where you are putting, and else if you are not open to do that, then better put it in FD and be satisfied with the 6-7% returns and the fixed income returns. But if you are putting your money in such assets, you should have some principles in place, stick to that, and once you analyze 3-4 stocks, then it will be very easy for you to analyze. It will not be time consuming for you. It's only the starting which is issue here, and as the channel here, you must have seen the description there. It is mentioned there that catch them young, watch them grow. So it is like buy the stock at very low price and watch them grow and become a multi-bagger. And another clause here is that invest independently. So don't take support of others. Yes, you can take support of me for analyzing or understanding how to analyze, but then once you master the value investing technique, then you should be independent and very confident, because once you trust yourself, right? So you can trust your investment rationale and go ahead, and whatever others tells, you don't have to listen to them.
Right. So I think to conclude today's things, I think he has given a good advice that you should have to refrain yourself from the tips you usually get in the social media. And few things that I would like to endorse his channel. It's not the intent of this video actually, but since I have been following this channel and I personally felt that that was worth for me, is that he is not charging anything. He is sharing his experiences, okay, and he is not giving you any screenshot. That is something which people do, that one of my follower has earned like this and something. So which is fact free, okay. And the third important thing is that he is actually putting you, okay, in a disciplinary way, okay, and the things are very clear that why we invest, where we invest, and I think that is important in today's world, because everybody is running behind actually creating the hypes about how he earned. And even one point is that he has not shared his own screenshot, right? Because sometimes people manipulate and give that hallucination that if you do this, you will earn like anything. So with his noble cause of sharing the information and I think making the youth, okay, more thoughtful about investment, sharing the good knowledge about how investment work for their betterment, we will end this session, but I am sure he will create more such content. And if it is for me, if I could do anything, so we will collab. But it was good discussion today. So think before you invest, go through all the details he has mentioned, and maybe you can, if you like this video, you can hit like, share
and you can comment in the comment box any improvements is required, and we probably wish to continue this podcast every weekend, probably Sundays, wherein we'll reel it out on Monday, or maybe try to reel it on Sunday itself, and maybe you can comment in the comment box of various topics which you would like to cover in this podcast going forward, and we'll try to cover that in the podcast.
Wonderful. So it was very interesting discussion. It was my first time to collab with Bijoy, because he was very SME, or maybe subject matter expert in that area. So I think you have enjoyed it, but if you enjoy, hit like, share and subscribe.
Do share. Yeah.
Thank you.
Thank you. Happy investing.